Considering, or it's considering, according to our reporting, options for its Chinese assets, including potential divestments, or maybe, and it's trying to streamline its portfolio. That's the overall aim here. And UK Retailers Guide could be in focus. BRC numbers looking pretty gloomy for the fourth consecutive month.
Maybe we in the UK do need to buy tin food. Anyway, let's talk about this equity market as it's about to start. Let's take a look at what is happening here. We are looking at a market that is fairly flat. FTSE 100's out of the gate, up a little bit. The futures were a little while ago pointing it's slightly negative, but I think it's a very finely balanced story there. Let's see what the retailers do today. Yesterday it was actually the banking narrative which drove the FTSE 100. Stock 600 up by 0.1%. Not much movement there. We'll wait and see some of the other markets open. Keep an eye on the luxury sector. It was Laura Piana, I think, was out with results. That could ripple into the luxury sector today, but it's hard to see that there was much in it that would change anything. CAC 40 down by 0.1%. IBEX is up by 0.2%. I've got nothing at the index level to tell me kind of what's going on below the surface, anything useful anyway. Tom's here.
Oil prices are higher, so that's lifting energy. That's your top gainer across the sectors, Guy, right now. Top of the list, up 0.7%. You mentioned the banking story, of course. We have the earnings kicking off stateside. JP Morgan later today, 1:30 p.m. UK time. We'll break that number for you, of course, around then, at least, JP Morgan earnings. Banks, again, they gained yesterday, to your point, Guy, and up 0.4% so far in the session. Tech getting a bit of a lift, up 0.2%. On the downside, the most softness, Anna, coming through. Construction materials down 0.6% so far. And then back to the index level, just moderately flatter on the FTSE 100, and the CAC current down at 0.2%, Anna.
Yeah, we're pretty evenly split, aren't we, from a sector perspective, about the sectors going up and the sectors going down. You're right that energy and banks are to the upside, insurance, construction and materials to the downside, but we are pretty evenly split. The overall move then in the stock 600 so far, 1 minute and 40 seconds into our session, we're up by 0.1%, not moving very far in a hurry.
It was Bruno Cucinelli. I mixed up my luxury stocks. I said Laura Piana. I meant Bruno Cucinelli. Easy mistake to make.
For someone who spends so much time on Bond Street,
I was just waiting.
Yeah, it's a shocking disappointment, falling on our estimations. We are seeing a bit of movement in some of the stocks that we flagged. So Diageo is up by 1.5%. That's interesting in London on talk of an asset sale over in China, the potential for an asset sale at least. And certainly using Next as a proxy for the UK retail space, non-food, we're not seeing a drop there on those BRC numbers, but we already heard from Next, didn't we, with their stock-specific update. That stock up by 0.3%, and Orsted not yet open, so still waiting for that one to respond.
Yeah, it does seem to be a bit of a read across from the Orsted story when we get that print from Vestas right now, which appears to be gaining pretty decently. In fact, I've just refreshed. Vestas up a little over 2%, so in terms of the read across on the Orsted story, and again, when we get the print from Orsted, we'll bring that to you. Again, on the FTSE 100, a little bit of softness for BAE Systems, so maybe defence under pressure after a couple of days' decent runs. Currently down 1.3%. What else is standing out to you, Guy?
Chocolate.
From fashion to chocolate.
I know.
You're bringing all the fun today, Guy Johnson.
Well, we've done the prepping thing, the tin cans. We want to move away from that. Linton Sprungly out with numbers this morning, and looks like the stock is responding fairly well to that. So the chocolate trade is on this morning. But also, is it open now?
Yes, it is. It's up by 5% on the back of that news out of the US.
That they can restart. They're 90% of their way through this project off Rhode Island.
While their legal challenge continues.
Yeah, so it looks like they've got a good chance of completing that within that time frame, potentially. So getting a lift on the back of that. Let's get more market analysis right now and bring in Henry Allen, Deutsche Bank research macro strategist. You're pretty bullish, despite the geopolitics, despite Fed independence risks, despite question marks about the resilience of the US economy. How are you thinking about what you're seeing right now to start the year? and whether or not that confidence is being put to a test?
Well, it's certainly being put to the test if we look at the array of events, as you say, the geopolitics from Venezuela to Iran. We've now had a serious challenge to Fed independence. But despite all of that, yesterday again, the S&P 500 at another record high. So I think that resilient story very much remains. And if I look at the high-level backdrop for this year, I do think it's still pretty positive. We've still got the AI story with capital expenditures, productivity gains. We've got more certainty on the trade side. And actually, we've got a big fiscal impulse coming this year, both in Germany, where that stimulus is going to impact this year, and actually Q1, we're going to see a big fiscal impulse in the US from Trump's big, beautiful bill that was passed last year. So I think at the high-level backdrop, things are still pretty resilient looking forward.
Trade, you mentioned trade, because we have 25% tariffs apparently being announced. We don't have the details yet on countries that trade with Iran. Is tariff risk not back to the fore for this Trump administration?
I think it's definitely there, but actually, as I look to the year ahead, I think the risk is on the downside. One thing I've been struck by, even in the last 2 or 3 months, is that as affordability concerns, inflation concerns have risen up the agenda in the US, they have rode back a bit on some of the tariffs. So we've already seen tariff relief at the end of last year on prominent foodstuffs that consumers obviously see, like coffee and beef. Actually, on New Year's Eve, it was filtered out that they were postponing extra tariffs on upholstered furniture by another year. So again, items that consumers are purchasing that are quite obvious to them, particularly with the midterms coming up, so there's a political incentive to keep inflation down. I think the risks at the tariff front are skewed on the downside. We've had the big increase last year. Actually, I think there's downside risk. And actually, the court case adds into that, because soon we're going to find out whether the Supreme Court might strike down the tariffs under the International Emergency Economic Powers Act. And although there are definitely alternatives the administration could pursue, even if they do strike those down, I could believe they take the opportunity to not do one-for-one replacements of that.
But how does that fit, good morning to you, Henry, how does that fit with news flow last night? President Trump saying, right, I'm putting another 25% on Iran's trading partners, which is, for example, India and China, where you already have tariffs at 50% or 30% in the case of China. And here's another 25% that he plans to put on top. That's a fragile relationship, certainly the US-China one. And it's already in focus this year because it'll need to be, that truce will need to be renewed. I suppose, does this just remind us that we maybe are not at the end of the story when it comes to trade tariffs?
Certainly, I think it's definitely a risk. But I think, firstly, we don't know the details as to whether that's additive or if that's separate. For instance, if a country already has a 50% tariff for the United States, is that 25% just incorporated into that? Is that actually an extra tariff on top? We don't know the details around that yet. And the other thing I'm conscious of, as we found out consistently last year, is Trump would often threaten additional tariffs. So, for example, shortly before he met with Xi in South Korea, he threatened additional tariffs of 100% extra on China that were actually never implemented. Trump often is used to throwing around these tariff threats in order to get his way in other policy areas. So I certainly wouldn't discount that that is a threat that he's leveraging in the short term that will then be dialed back.
So if the trade threat is fading and if the US looks a little less attractive given all the Fed independence conversation and we're spending a lot on infrastructure and defence here in Europe, there are a lot of people tell us that Europe is, the place to be and exciting. But then looking at a sort of more technical chart provided by colleagues today, the Stock 600 showing really strong momentum and actually could be defined as being overbought, the most overbought in 10 years by some measures. Does that sort of thing worry you, looking at Europe?
A little bit. I mean, European equities have been on a tremendous run recently. I mean, one thing I was struck by, actually, the DAX is now up 10 days in a row. And futures, as Tom was showing earlier, are also pointing positive today. If we get an 11th gain for the DAX today, that's the longest run of consecutive gains since 2014. So a pretty striking run that we're not used to seeing. It's not usual to get kind of day after day after day all-time highs. So if we do get a little bit of a pullback from that, that doesn't alarm me. One thing I'm struck by, we see in the US context as well, that we get these kind of 1 or 2% sell-offs, and the headlines are very much talking about this as though, is the AI bubble finally bursting, when actually these are fairly moderate sell-offs by historic comparison. I think the same applies to Europe as well, that you're going to get, not every day is going to be an all-time high. You're going to get these periodic pullbacks, and that shouldn't in and of itself alarm us.
You said many interesting things. Let me pick up on one of them. You said that Trump may not replace tariffs one for one. What we've seen over the last few days is Trump clearly is worried about the bottom end of the K. He's worried about the midterms, and he's going to try and use all the tools in his toolbox to try and solve the affordability crisis. Does that include tariffs? Is this an opportunity? Say the Supreme Court comes out tomorrow and goes, no, you're done, the APA tariffs don't work anymore. Is that an opportunity for him to take the tariff burden down in order to help that group of people into the midterms?
I think it's absolutely an option open to them, as we've seen with the relief on the tariffs on coffee, beef, furniture, etc. And actually, one thing, for instance, a strategy they could pursue, for instance, is the Supreme Court case does not cover the sectoral tariffs, the Section 232 tariffs on things like steel, aluminium. So they could up the tariffs on some of those sectors, but they don't have to do as high tariffs as they would that would replace the IEEPA tariff. So I think that's absolutely consideration. And I think that also filters into what's happening around the Fed as well right now, because one of the pressures on the Fed is, of course, to get interest rates down in order that, things like car loans, credit card interest rates, that's a big focus. It's all, you can view it all through the lens of affordability. And I think what has happened is where, in particular, you had those elections last November, where in New York City, in the Virginia and New Jersey gubernatorial races, which the Democrats won across the board, they're now concerned about affordability because that's a political problem.
What do I put in my affordability bucket? Say I believe that story, that Trump wants to win the midterms and he wants to solve the affordability crisis. What's the yesterday it was the staples. The staples got bid yesterday, and that's why the stocks went to a record high. It's odd. What else do I put in my affordability bucket? Is it the staples? Is it what benefits the bottom end of the kind of the socio-economic groups? Is it lower rates? How do I think about that as a package? Because Trump clearly is going to try and push that policy quite hard, and you kind of want to follow the policy.
Yeah, well, I think two areas we've already seen are, one is rates, particularly mortgage rates, which there's been pressure to come down, hence the stuff like the MBS purchases. The other is actually the more prominent aspects of the consumer basket, because not just in the US, but something we saw in Europe, of course, when inflation was surging in 2022, was actually the particularly painful items were stuff like food and energy, the stuff you cannot substitute.
How do I trade that? What's the trade on that?
Well, I mean, actually, staples, like you said, have done pretty well in the last couple of days based on those kind of trades, because actually, if you do something like food, firstly, that's something that everyone has to consume. You can't substitute away from food in the way you can from luxury flights and foreign holidays or shopping on Bond Street, like you mentioned. So, there are risks.
Mentioned, not me.
Well, about yourself.
I mentioned Guy Ducks.
So, it's an issue. So, there's that. And then I think, you've got, as you say, that yield curve steepening as well, because if Trump is putting pressure on the Fed to bring down rates, actually the pressure remains. The Fed, indeed, even before the threats on Powell, the dot plot was still saying the Fed planned to cut once this year. So I think the direction of travel for the Fed is still downwards as well. But clearly there's that pressure on the long end, not just because of Fed independence, but also the fiscal stuff.
Just briefly, Henry, do you bet on an overheating US economy then? Because that's one of the risks that you're watching for this year.
Yeah, I think actually my bigger concern, I'm more worried about an overheating US economy than one that goes into recession this year. One thing I'm really struck by is this quarter alone, we have the biggest fiscal impulse of any quarter since the Biden stimulus. And that was in a recessionary context with unemployment at 6 or 7%. So that's coming through from the big, beautiful bill. The Fed have just delivered 175 bips of rate cuts since September 24. That's the fastest pace of rate cuts outside a recession since the 1980s. So you've got this dual monetary and fiscal impulse outside of a recession of the sort we haven't seen in several decades. So my bias is that actually the reacceleration risk is stronger for the US economy right now than the recession risk.
So that's a hike in 2027, isn't it?
I think definitely that's certainly, the probability is that is definitely going up because, I guess the thing you have to then set that against.
You've just mapped out a path towards higher rates.
I have. But the risk to that then, as the whole discussion is centered around, is what does Trump do about the Fed? Because in a normal environment, yes, you would absolutely say, given that environment overheating, the Fed are going to want to hike.
But this is not a normal environment.
This is not a normal environment. As Chair Powell himself has said, this is being used as a pretext for lower rates at the Fed, and Trump has made very abundantly clear that whoever is the next Fed chair is going to be, in his words, someone who believes in lower interest rates. So then you're setting up a political battle for 2027. And of course, it's not just about the chair. We also, January 21st, have the Supreme Court hearing the Lisa Cook case. They're going to be deciding whether she can stay on the board. Her term goes up to 2038 as it stands. So if he can remove Lisa Cook, that could potentially refashion the entire board.
This year looks quite interesting. Henry, nice to see you. Henry Allen, Deutsche Bank research macro strategist. Core 6 looks like this. I'm going to sort of move past this fairly quickly, and we'll get on to Chloe Mele. That's the picture across Europe right now. Chloe, what have you got? Let's start with the wind story.
Yeah, good morning, guys. So as expected, Ørsted is moving higher today after a U.S. judge ruled that it could resume work on a wind project on the coast of Rhode Island, which is a project that the Trump administration had suspended. So this is seen as a big win for Ørsted in this fight, this ongoing fight against the Trump administration. And so we are up quite strongly. And it's also seen as a big win for that renewable energy space more generally. And so we have got quite positive movement there for Ørsted. Moving on to Diageo, which is also also on the move today, and it is up about 2.3%. It is said to be considering different options for its Chinese assets, including potential divestments, and this is part of a broader strategy to streamline its portfolio, an attempt for Diageo to kind of move forward as people are starting to drink perhaps less and less, and so we are seeing this potential divestment there being taken quite well by the market. Moving on to ASM International, which is down after Jefferies downgraded that stock, saying that for the semiconductor sector, we will have quite a choppy ride in 2026 because outside of AI, demand remains actually quite weak. And so we are a little bit weaker for that stock this morning. And finally, Symrise, which is a chemicals manufacturer, is up very strongly this morning, about 7%. It is divesting its terpenes division, which is organic compounds found in plants. I didn't know, but now I do. And this is a divestment that is being taken quite warmly by the market. And we're up, as I said, 7% for Symrise.
Every day's a school day, Chloe. Thank you very much. Chloe Melly with the latest on those stocks that we are focused on today. Coming up on the programme, fair winds then for Ørsted's Revolution wind farm project after that favourable legal ruling in the United States. Fair winds for now. We'll get the broader context on this story next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. You're watching the opening trade, 80 minutes into the equity market session, and I had nothing to say. There you go. Equity markets are up a little bit in some cases and down a little bit in other cases. What that tells you, though, is that below the surface, there are more exciting things happening, and Ørsted is certainly one of those stories, Anna.
Yeah, absolutely. Ørsted shares are on the move after a US judge ruled the energy giant can resume building a wind farm project off the coast of Rhode Island. Bloomberg's Christian Weinberg is with us from Copenhagen. And Christian, run us through the details then of this ruling and what it means for Ørsted, because they still have the bigger legal challenge to go ahead with, don't they? This is just, you know, you can carry on with your work in the meantime.
Yeah, that's true. Well, for Ørsted, this particular project is special because it was almost complete when the Trump organization made the stop order before Christmas. Now the judge has ruled that Ørsted can continue building, and analysts estimate that it will be a lot harder for the Trump administration to stop this particular project once it starts generating electricity to Rhode Island homes. So there's a bit of a race against time here, where Ørsted is presumably eager to start building again very soon, and presumably will be able to generate electricity later this year.
In terms of what happens next, what is the White House indicating in response to this? And can I extrapolate this into other wind farms and other suspensions that have been applied?
Yes, well, so the Trump administration has said, and bear in mind, this is the second time that Ørsted has won a legal battle against the Trump administration regarding offshore wind parks. But the Trump administration went out and said yesterday that they will continue to fight offshore wind, and they expect the ultimate victory will be theirs. But and I guess that suggests that we'll see a lot more obstacles coming from the industry. And as you rightly say, there are other developers who have parks that are being challenged by the Trump administration. Ørsted has another park in New York, Sunrise. It's not nearly as complete as this one, Revolution in Rhode Island, but the same judge will look at that one also, which bodes well for Ørsted. And Equinor, the Norwegian energy giant, also has its park, which is called Empire Wind. That has also been halted. The same judge will also look at that one. The industry is obviously very optimistic about this. You can also see that the Equinor shares are also gaining in Oslo today. So this is a relief for the industry, but it's probably not the end of it when it comes to obstacles put in place by the Trump administration.
Okay, potentially more hurdles ahead. 5.6% is the gain for Ørsted right now. Bloomberg's Christian Weinberg with the update there. Christian, thank you. Meanwhile, the FT on the banking space reporting this morning that UBS CEO Sergio Ermotti is planning to step down in April of 2027. The Swiss banking chief is preparing to depart at a crucial time for the bank as it fights Swiss government plans to tighten its capital requirements, again, according to the FT. For more on this, let's bring in Bloomberg's Swiss finance reporter Miriam Balazzo. Miriam, what do we know about the reporting? What do we know about the potential decision? What would underpin? Why would Ermotti be looking to step down around this time next year?
And so, hi, Tom. It's actually not so surprising because when Ermotti came back 3 years ago, he did say that he would step down once the integration is through, the integration of Credit Suisse. And he and the bank had always indicated an end of 2026, 27 timeline. So this would be in line with the timing that the bank had indicated. What we had thought, though, was that he would stay a bit longer because of the capital debate that was ongoing with the Swiss government, but this is looking better, this is looking up. So the initial timeline that he had set up is now still on track for 2027. And I think we all we were all taken by surprise that things have gone so quickly since the acquisition, and a lot of things have gone smoothly. So I think this underpins his departure. And now the question is succession. Who can fill up those shoes? We know that the bank is favoring an internal solution, but we're not also overlooking a potential external candidate. But there's a lot of people internally that are lining up for this role, that's for sure.
Miriam, stay with us for just a moment. I want to talk about what's happening with the capital rules, but first I think it's probably worth playing a bit of the conversation that Ermotti had with our Stephen Engel talking about the Swiss banking reform story. So let's just listen to a little bit of that conversation.
We fully understand the necessity of taking the lessons learned from what happened at Credit Suisse. But we believe that the current proposals are not really reflecting what happened at Credit Suisse and are going too far. And therefore, we are contributing in the debate with our views on the matter. But this is now a political process. We hope we're going to get more clarity in by the second half of the year.
Second half of the year. Are there compromises that you would potentially accept? And that conditions of doing business, is it a hindrance, obviously, to be still domiciled in Switzerland?
No, look, first of all, there is a compromise is usually between two people negotiating something. We are not in a negotiation. It's a political process, and therefore we need to see what's coming out. As I said, our role right now is to make sure, on behalf of our shareholders, our employees, our clients, and in general to the public, that we contribute our views on the matter. But we are a Swiss bank. We are very proud to be a Swiss bank. We believe that is a differentiating factor. We believe this is good for Switzerland, and we want to continue to operate as a Swiss bank going forward.
So it's not necessarily a compromise, because, as you said, that would be a negotiation, right? But are you confident that they will come up and there will be a resolution that will be acceptable to UBS?
I cannot be confident about that. I think that I'm pleased to see that there is a political interest to go deeper and fully understand the details of this. It's very important to understand the details of what's going on. So such an important decision cannot be taken out of emotions or by people trying to drive the agenda by fear.
We're getting there. We're not there yet. Maybe we get there. Maybe the read, the skinny on that conversation in terms of the capital story. Miriam's still with us. How close do you think we are to a compromise? Listening to that conversation, are we any closer than we were?
Definitely. I think a lot of positive momentum has been created this past few months. As Amoti was saying, it is not a negotiation because they are not... The party can submit their suggestions, their response, which they did yesterday, highlighting the fact that the existing rules the existing proposal jeopardizes the continuation of UBS business model as it stands, and also would impact the Swiss economy as a whole. However, we're seeing a lot of support from the Swiss Banking Association, Swiss Business Lobby, also the leading political party, the SVP, here in Switzerland, has also showed its support to UBS and backed that argument that the rules have to be watered down. So there is hope that a compromise could be reached. When this could happen, this is still a question mark, but the next step is to go to the parliament.
Thank you. Thank you very much. Miriam Belazou joining us there with the latest on UBS. Coming up, we'll take a closer look at the Trump administration's battle with the Fed and discuss wider macro and market themes. This is Bloomberg.
Crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into your Tuesday session. And yes, there isn't a huge amount of excitement in these markets, the headline level, but we are building on record highs that were notched on European markets and on the S&P 500 yesterday. We'll see if that continues stateside today, of course. Across the benchmark here in Europe, modest gains of 0.1%. Again, given the upside that we saw yesterday, not something to be sniffed at necessarily. Over in Germany, the DAX is adding 16 points. You're a little softer down in France, down 0.2%. And the FTSE 100 in the UK might be flagged lower, currently flatlining essentially for the FTSE 100. Maybe there's a bit of cash on the sidelines ahead of inflation data, Guy, later today out of the US. CPI, of course, in focus, which could be the first clean print that we've seen since, November?
Absolutely. Clean data certainly helps at a confusing time. Let's talk a little bit about what is going on in terms of the internals. 267 up, 317 down. Again, doesn't tell you very much, I don't think, in terms of the nature of what this market it kind of feels like at the moment. Volume's a little off, but not by much. Single stocks, I think there is some interesting stories here as to what is going on. Orsted certainly is one of the standout narratives that we've been watching throughout the morning, winning having a near-term win against the Trump administration. Is it a long-term win? We'll wait and see. But certainly it is being helped out by the fact that a judge has allowed it to continue to build off Rhode Island, its wind farm in the near term. That stock is responding quite strongly to that. Santander's up 1.43%. Explain some of the outperformance maybe we're seeing out of Spain. Novo Nordisk is also up. There were some comments, I think, coming through from the CEO yesterday relating to the weight loss pills they're now selling into the United States. That seems to be going quite well. Astra, on the other hand, is softer. That's a continuation of a trend. Vinci is one of the reasons why we're seeing the French market down as much as it is. I think that's a downgrade. That is weighing on the French market today. And Sika is also down very, very hard, 7.25%. So within individual stocks, you are getting some movement. Net, what's happening is that actually you're getting a lot of cancelling out, and as a result of which volatility just remains incredibly low at this point. Anna, over to you.
Guy, let's get an update on some of the other stories we're following this morning. Over to Japan, the yen has dipped deeper into an intervention risk zone after the Japanese Prime Minister Sanae Takaichi's reported plan for a snap election. The Kyodo News reports that Takaichi plans to announce a dissolution of the lower house at the next parliamentary session. In a bid to prop up the yen, former Bank of Japan board member Makoto Sakurai says that the bank may raise its benchmark rate as early as April. President Donald Trump says he is imposing a 25% tariff on goods from countries doing business with Iran. The move ratchets up pressure on the government in Tehran that has been rocked by widespread protests. The announcement also risks derailing the U.S. administration's one-year trade truce with China, which is the world's top buyer of Iranian oil. And the Trump administration's actions against the Fed Chair Jerome Powell have triggered a backlash that could derail the White House's plans to tighten control over the central bank. Fed officials and U.S. senators from both parties have pushed back on the investigation and reiterated the importance of an independent central bank. Senate Majority Leader John Thune said that the threat of a legal battle with the Fed could make confirming Fed nominees, quote, challenging. Something we touched on a little yesterday, Tom, but lives on as a market narrative.
Well, let's get another view on that story and bring in Michael Zizas, Deputy Head of Global Research at Morgan Stanley, joining us around the desk this morning. Fantastic to have you on set with us, Michael. Thanks for joining us.
Yeah, thanks for
Let's
having
start
me.
with, there's a lot we can talk to you about, and so we're really looking forward to this conversation. Let's start with the Fed. How damaging is this for the Central Bank of the United States?
Well, I think we have to see what the end game is first, right? So obviously it's quite damaging if we were to not have an independent Fed. If we ended up in a situation where the president could effectively choose who the Fed chair is and who is on the board and effectively therefore set monetary policy. We're certainly not there yet. And so right now, monetary policy for us is still very much governed by the traditional aspect of how the FOMC is making its decisions, which we think really has kind of shifted, in particular after last week's non-farm payroll report, from being very labor market focused to very inflation focused. And so we still think you're going to have two cuts at the end of this year, or towards the end of this year, really more contingent on inflation starting to come down and that being proof of concept. If the president, however, sort of gets his style of monetary policy more in vogue with his Fed chair, or getting the right Fed chair on board, maybe you're going to have more of a permissive attitude around the idea that inflation will come down further. There's a productivity story, and so maybe there's more cuts on top of that. But that's where we think really the debate is right now, the sort of the legality of whether or not the president can actually put the right people on the board. Yeah. That's still TBD. The Supreme Court, the Lisa Cook case, I think that's really the touch point we have to look at.
I mean, to your point, there's a number of different scenarios that could come through on the back of this, but these are extraordinary times.
Sure.
And if we do get the scenario where President Trump is able to reshape this institution in his image, as he's done with other parts of the government, what does that do in terms of your views about the debt and the deficit of the United States and yields at the long end? I mean, when do we get to a crunch point on that?
Well, and so I would distinguish between reshaping the institution in his image via traditional channels, i.e. getting his appointee as chair, and sort of as more appointees become available, getting people who are more like-minded with their economic view, which would be a little more, hey, look, we could be dovish because we expect productivity to pick up. That's more sort of traditional channel, and it potentially preserves the independence of the Fed. If you're talking about a situation where the Supreme Court says that the firing of Lisa Cook was justified, and therefore you end up in a sort of close to de facto situation where the president can do what he wants with the Fed, then yes, I think the markets you point to are exactly the shock absorbers you'd look at. You'd look at a substantial steepening on the long end of the curve, the 30-year selling off, the term premium being higher, and the dollar being considerably weaker. You saw some of those trades go in last year in anticipation of this being somewhat higher probability, but there would certainly be more room to run there.
Dollar keep weakening from here?
So again, I'd say
what is the higher probability? Is the higher probability?
I think the higher probability is that we've got some weakening to go on the dollar,
but not much.
But not much. I mean, we were close to 10% down on the dollar last year. We think we have a little more to go, but you're mostly going to stabilize for the rest of the year.
Okay. Can I put the Fed story into what I'm increasingly calling the affordability bucket?
Yeah.
Trump wants to get everything, the cost of everything down.
Yeah.
Credit cards, groceries, whatever it is, he wants the price down so he can win a midterm election.
Yeah.
How do I trade? What does that basket look like to you? And is that a trade that I can put on, should put on, in and around that policy package into November?
I don't think that there's potentially a trade there, because a lot of these efforts, they're sort of questionable in terms of what the actual fundamental impact is going to be, right? So take, for example, what they're trying to do with bond buying of mortgage bonds, right?
Bonds, yeah.
Right. So we are potentially getting mortgage rates down, 30 basis points or so.
Yep.
What our team would say about home price affordability is it's really only going to impact that marginally. So it's not necessarily going to impact that story all that much. To the extent there's a through line from policy two markets, we don't really think it's about affordability. We really think it's about the corporate capital expenditure story and AI in particular.
So not selling banks, buying staples, there isn't that kind of a trade that goes on into the midterm?
I don't think so. However, I think where we'd be wrong is we should pay really close attention to the Supreme Court decision that potentially is going to be delivered tomorrow on the tariffs themselves, right? So if the Supreme Court does strike down the use of these IEEPA tariffs, and the administration were to choose not to reconstitute those tariffs through other legal means, we think they would. But let's say they didn't.
Through the affordability lens, they might not.
Right, exactly. That's a possibility I think we at least have to entertain.
Yeah.
Well, in that case, then you certainly do have all types of consumer goods that all of a sudden the cost of importing those goods comes down, and there should be some give back on inflation there.
Good morning to you, Michael. So we are focused on affordability, but it doesn't necessarily deliver by your analysis, certainly on the mortgage bonds, and we could look at other examples of that. Are you concerned about possible overheating in the US economy? We just had a conversation in the last part of the program with another guest from Deutsche Bank who was saying that that's actually very much on the radar. So despite the conversation about whether we get rate cuts at the Fed, actually what he's worried about is whether we see overheating in the US.
Right. We are concerned about that. We think it's probably just too early for that story. So take the AI theme, for example. If we think the U.S. is going to spend something in the neighborhood of $3 trillion in AI capex over the next few years, $1.5 trillion of that should be debt funded. That's a lot of debt in the private sector. However, we're starting from a place where corporate balance sheets are quite healthy, debt to EBITDA levels are pretty reasonable, cash to debt levels are quite low. So there's a lot of room to sort of absorb that debt issuance behavior. So we'll have to track that over the course of the year. We think that's going to be potentially the red flag that tells us there's some overheating risk, but we think we're pretty far from that. There's plenty of capacity to make the attempt to spend a lot on CapEx in the AI race and in the reindustrialization theme.
And what's the unexplored opportunity then in that AI CapEx build out? Because we've talked about it for a long time. We know the names of the companies that are doing a lot of it and raising that debt and spending their money on it. But where does it go next? What's the next part of that build out for you?
Yeah, I mean, there's lots of ways to answer this question. I think a really interesting way, though, is about how the adopters might be experiencing their own productivity increases. And so our equity strategy team and Mike Wilson's pointed out that if you look down to mid-cap, U.S. mid-cap and U.S. small-cap stocks, you're starting to see earnings growth you haven't seen in the past. Now,
the Russell's had a really good start to the year, hasn't it? Versus
right. So I think you've had about 8% earnings growth there. It's a swing from being negative 8% a year ago. Now, is this necessarily AI? I wouldn't necessarily put it on that bucket, but it's almost certainly a productivity story. There's probably some deregulation inside of that story, and so I think there are some downstream effects that you're starting to see thematically in mid-cap and small-cap stocks.
Do we put to bed the Mag 7 outperformance story? Is that done?
No, I don't think so, but I do think that a lot of that will hinge on what your view of the AI story will be going forward. And here I'm not smart enough to tell you, right? So the sort of the frontier model builders, particularly within the Mag 7, if they have substantial success in delivering models that show that there's still exponential increases in intelligence there, then yeah, the sort of the potential ROI on that technology is still massive beyond what's priced in. If it starts to slow, then perhaps the adopters are where more of the juice is going to go.
How are you thinking about Europe versus the US in equities?
We prefer the US, but I think the European story is still quite a good one. There is sort of more of a CapEx story going on there. There's still more of a defense element going on there. So nothing sort of out of the ordinary, I would say, out of consensus, but we do think that the U.S. is still where more of the CapEx-driven innovation and CapEx-driven productivity is going to be, and that's ultimately going to flow through the bottom line.
When you talk to clients here, and they go, what's the trade? Kind of, what's mispriced? Where am I? What do I need to do here? What looks obviously wrong to you?
Yeah.
What's the answer to that question?
Yeah. Well, first of all, it depends on the type of investor you're talking about. But if we're just talking about like broad cross-asset purview, one area that we've pointed to as sort of a potential surprise is if you're a credit investor in the U.S., we actually think that high-yield credit is probably going to outperform investment-grade credit this year, which you wouldn't necessarily expect in this environment. But a lot of it is because of the AI theme we were talking about earlier, a lot of the CapEx that comes along.
Isn't that a run-it-hot economy trade, though, isn't it? Is that...
That's right. That's right. So It's sort of a technical that's reinforcing a fundamental, right?
Yeah.
There's more supply coming into the investment grade market, and then of course because the economy is doing better than we thought, high yield bonds should actually.
When do you want to get out of that trade?
Not this year.
Okay.
Ask me again next year. Yeah.
Okay.
Yeah.
Okay.
Yeah.
And from your perspective, sitting mostly in the States, Michael, I mean, we talk every day about the latest policy coming out of the White House in whether it's, mortgages or the defense sector or all kinds of sectors that fall into the focus of the president. Follow the policy is one of the themes that we've been exploring. I mean, we talked about whether it was the K-shaped economy, not necessarily, you said. I mean, how are you managing to keep a track of that and keep ahead? I mean, you can't be ahead of that kind of thing, can you? Because some of it comes from left field.
Well,
or did you have to just be responsive?
I just you do, and I don't think there's really. So it's interesting. When we first started very intensely covering the interaction between U.S. policy choices and markets, a lot of times traders and our clients would ask us, "Give us calendar events for when President Trump's going to announce X, Y, and Z." You're like, well, there is no calendar of events.
No.
It's not.
Wake
not
up
like
at 2 o'clock in the morning and you kind of.
Well, exactly. It's not like the ECO screen on your Bloomberg terminal, right? So some of this is, if you're an emerging market investor, you sort of always implicitly understood and you grew up with the skill set and the knowledge of the intersection between policy choices and markets. I think U.S. investors are starting to, developed market investors writ large, starting to embed this as part of their process.
What does it tell us that they have to do that? And then we have former Treasury secretaries and former chairs of the Fed coming out and saying what we saw over the last 24 hours was very much like emerging markets.
Yeah.
I mean, what does it tell us that that's the training that is helpful for covering US assets right now?
It tells you that the world is in motion. There's a major secular theme we've been tracking for most of the last 10 years called the shift to a multipolar world, which is not the same as some people say it's like, oh, is the U.S. becoming an emerging market country? That is too reductive a way to think about it. The intersection between policy and markets is just happening more and more and more. And there is a different consensus for policy in the U.S. that it used to be about free trade and government non-intervention. Free trade is now seen, for better or worse, by the American voter as a bug and not a feature. And interventions into the economy are not necessarily dissuaded, right? And that's a view of both the Republican and the Democratic voter. So this is a kind of secular through line that I think investors have become accustomed to, will have to keep becoming accustomed to, even if President Trump's not in office.
But that investing along the lines of a more interventionist U.S. government in the private sector, that is not a short-term, that is a longer-term thing, I think. Because it seems to me that investors are still kind of waking up to that.
Does it come with a discount? Does that imply a discount to assets? Because that is a key question. Are assets in that kind of world less valuable?
Well, let's say it's still what we're talking about is still quite small compared to other countries that have more interventionist policies, right? But sure, if you're talking about the slippery slope argument, but for example, with the U.S. government taking a stake in a small mining company, to try and get rare earths minerals out of an Alaska mine, it's still ultimately a very small number.
But telling credit card issuers that they can't put rates above 10% feels slightly different to that.
Sure. And now we're obviously testing the limits of executive power. We'll see where this goes. There have been more guardrails in place that I think people appreciated from the legal system and from Congress. Potentially, Congress is an activity in and of itself. So, I agree that we have to watch the slippery slope carefully, but we shouldn't jump straight to the U.S. as a managed economy.
And it's about passing, as you said earlier, it's about passing the announcement with the real on-the-ground impact as well. Right. Michael, thank you very much indeed. Michael Cesis, Deputy Head of Global Research at Morgan Stanley. Thank you. Coming up, how many jobs is Citi expected to cut this week as CEO Jane Fraser continues her push to trim costs and improve returns at the Wall Street Bank? The answer when we come back. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Welcome back. Now, before the break, we asked how many jobs is Citi expected to cut this week. No pleasure taken in announcing this, but it is a fact, so we're going to highlight it for you. The answer is about 1,000 jobs. Bloomberg has learned that the company, of course, which had 227,000 employees at the end of September, is culling its ranks as part of a plan announced 2 years ago to eliminate 20,000 jobs by the end of this year. Streamlining the bank and cutting waste has been a key goal, of course, for the CEO, Jane Fraser. Citi's performance has long been a laggard compared to other major US lenders. Anna.
Well, the banking sector will be firmly in focus, won't it, today? That'll be one of the things on our agenda. We'll get bank earnings coming up later. We'll also, though, have US CPI data to deal with. We'll have earnings from other parts of the US economy and some Fed speakers to listen to as well. Barkin and Muslim will be speaking. And President Trump will be getting a briefing on Iran, Guy, which, of course, is going to be something that we will be watching. But before that, we get the bank earnings story in focus.
We're going to watch that very, very carefully. I'm looking forward to hearing what Jamie Dimon and others have to say on what is happening with the credit card business. Wall Street, biggest banks kicking off earnings season. Expectations of near record profits are certainly being buffeted by what is happening around the layoff story, which kind of normally comes around this time of the year, and potential policy changes out of Washington. How do we fold it all together? Well, the way we fold it all together is we're going to talk to Charlie Wells. He's here with the latest.
Guy, that's exactly right. And I mean, we are hearing a lot of turbulence in the banking sector this week, a lot of short-term turbulence, I would say, thinking about some of these policy ideas coming from Washington, not sure how those will factor out. But when you zoom out from this week, when you look at that past year, you see the strength of that KWI index, those major lenders outperforming the broader market, a lot of optimism in the market about these banks and strong fundamentals. And one of the most fundamental themes that we are going to hear about, no doubt, as these banks start to report is deal flow. We have seen in 2025 the best year for deals since 2021, that record-setting year from 2021 really manifesting these green shoots that investment bankers had been talking about for years since that time, finally coming to fruition in 2025. What happens when you get that deal flow? You get investment banking fees clipped from there. You can see that to the tune of almost $10 billion at some of these major banks. We're really seeing JP Morgan, a leader here, Goldman Sachs. So this is a theme that, despite some of this short-term turbulence that we've been hearing, is really going to come out loud and clear today.
Okay, the art of all those deals and fee generation then in focus, and certainly those will be in focus then when we hear from the first US bank to report this week, which is JP Morgan. Charlie, that report dropping on the Bloomberg terminal later today. So how are analysts expecting America's largest lender to perform?
Look, so there's one number that's really jumping out from Fortress Diamond this morning to me, and it is this growth in equities trading. We're seeing growth of over 31% in the quarter. That is, of course, because there has been a lot of volatility in the market that investors have wanted to reposition, and trading desks have been able to take advantage of that. So you see some of, the investment banking activity boosting these banks. You also see it boosting these trading desks. But of course, there also is this theme of growing loan growth in this environment where we are seeing the potential for lower capital requirements. You are seeing some of these major banks, and JP Morgan really has taken leadership here, growing their loan books. So the fastest growth in loan books since 2010. So we're winding back some 15 years there. But I've got to say, risks remain, and I think getting complacent is the issue that we are seeing that this morning could not be beneficial to investors. And some of the risks here, surprises on expenses. We saw when JP Morgan talked about expenses last month, that really hitting their shares. You could see some commentary, some forward-looking commentary on potential momentum coming out of that AI boom, coming out of this M&A momentum, and also that macro uncertainty that we just see in the market right now.
Charlie, great stuff. Thank you very much indeed. Charlie Wells on the banks. Talking of macro uncertainty, let's talk about what we could get when it comes to the CPI number a little bit later on. Skylar's back to talk us through what the market is looking for on this number out of the United States. Upside risk?
Yeah, I mean, the issue is you have conflicting factors, right? So I think it's very hard for this to be a dovish print because we had strong employment last week. We know the Fed is looking more at the employment mandate than the inflation mandate. And so that tells you that it's a relatively hard bar to be dovish. I think the other thing to consider is when we got the November and December data, November and October data, it was a big surprise to the downside because it was distorted by the shutdown. So if you have a weak print, you just go, oh, well, maybe it's just still distorted. But on the other side of it, you have consensus expectations are for a hotter print.
So if it's not strong, I can ignore it, basically.
Yeah, I think that's largely the message. And I think the issue is if it is strong, your 10-year yield is at the top of the range. So is that enough to have it break out? Probably not. You probably need a series of hot prints, or more likely, you need to see a reacceleration in growth.
What's more important, is it the inflation data or is it anything else on the Fed? It was interesting to hear from Michael Zizas at Morgan Stanley a few minutes ago, and he said what he would be watching for potentially to be more concerned about the Fed would be a Supreme Court ruling in favour of the Trump administration on Lisa Cook. What would you be watching for on that front?
Yeah, I mean, absolutely. That is something that I would be very concerned about the Fed from, in terms of that sets the precedent that you can get rid of Fed governors, and that means you could have a broad turnover. Because what's stopping you from having the loss of Fed independence now is the fact that you have many members that vote. There isn't a big turnover this year. Stephen Moran's position is potentially turning over. We don't know whether or not Powell's resigning. So that's a maximum of 2 unless you're able to turn over these other positions. And because of that, you can't skew the vote count to having more cuts priced in or more cuts than what the market thinks is reasonably priced in. So I think certainly if we had that turnover, it's something to think about. But I think the bar for it is relatively low, which is why the market's not pricing it or looking at it super closely.
Okay.
You see, Skylar's maybe not remotely interested in CPI now. So, everything else seemed very fascinating, but you didn't seem too moved by the CPI.
Guy was very happy that Skylar wasn't excited by CPI.
Can you get out of the 10-year range that it's been in? I think it's...
And if it doesn't, if it's not hot and it doesn't do that, then move on. Move on to more Fed narrative.
I don't know what's more important. Is it the Guy tin can trade or is it the Takaichi trade over in Japan?
The tin can
trade still has legs.
Yeah.
This is the staple
Wall
story.
Street prepping story, I think, is one to watch for. Though Michael Zizas was completely downplaying that. He's not into tin cans. But Takaichi's going to be interesting. That ripples into other markets. Is that going to be enough to get us out of the 10-year? I don't know. Lots of things to get us out of the 10-year range, maybe.
Lots of questions. In the midst of all of that, what do we think about the healthcare sector and what it's doing? We're going to be hearing from the JP Morgan Healthcare Conference later on today. The Novo Nordisk CEO, the Roche CFO, the AstraZeneca CFO, all of those voices speaking to Bloomberg. So lots to come on that sector. That's it for the opening trade. Busy morning. The Pulse is up next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The Trump administration is accused of weaponizing the Department of Justice to attack Fed independence, with key Republicans criticizing the criminal investigation. The Takaishi trade roars back on reports that the prime minister is planning a snap election to capitalize on high approval ratings. Plus, Citi and BlackRock announced job cuts, and JP Morgan kicks off earnings on Wall Street. So, good morning, everyone. First thing is first. It's only Tuesday, but it feels like another very busy day on the markets. We're across all of your main stories. If you look at U.S. futures, look, equity futures seem to be trailing global stocks a touch as the earnings season gets into full swing. Investors, of course, awaiting the December inflation data. The stocks rally, of course, key risks out there is the U.S. inflation, but also possible Supreme Court ruling on Trump's tariffs. Now, the things we're looking out for, S&P futures look 0.1% lower, yen 158.93, Brent crude 64.59. Now, the picture in Europe is really one of reflection of what's going on in Asia, but also maybe looking ahead to the U.S. Open, a little bit unchanged. We're just seeing a little bit of pressure on the CAC 40. We'll have a full roundup on the politics in France shortly. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Trump administration's actions against the Fed chair, Jay Powell, have triggered a backlash that could derail the White House's plans to tighten control over the central bank. Fed officials and U.S. senators from both parties have pushed back on the investigation and reiterated the importance of an independent central bank.
Throughout that time, he has been completely dedicated and committed to the Federal Reserve's mission to support the American people. And throughout that time, he's proven himself to be a man of impeccable integrity and a man who has been calmly leading the Federal Reserve through times of heightened uncertainty and led us very effectively.
That's what this probe is. It's a pretext. It's a way to try to knock the legs out from Jerome Powell. I'm no Jerome Powell supporter, but I am a supporter of Fed independence. And the weaponization of the Department of Justice is fundamentally wrong.
Well, we're now joined by Bloomberg senior editor Alistair Bull. Alistair, good morning. Another obstacle in Trump's path. How is this going to affect his plans to replace Jay Powell?
Well, good morning, Francine. I mean, they'll stop them dead until this matter's cleared up. He's lost. He's losing. He's been clearly warned by senior Republicans that they see this as a direct assault on the independence of the Fed. Most importantly, Republican Senator Tom Tillis has said he's going to block any Fed nomination to the board until the matter's been resolved. And let's not forget that the important news we were expecting around the Fed was going to be Trump's pick for the next Fed chair. That could come this week even. I mean, probably not now, but I mean, certainly we're expecting it in January. If Tillis carries through on his threat, any nomination is going to be blocked in the Senate Banking Committee, and that's really going to grind the thing to a halt.
Yeah, Alistair, I mean, Jay Powell is Fed chair, but he's also Fed governor. So has this made it more likely that Powell will stay on as governor when his chair term expires?
We don't know that, but certainly there are people who listened carefully to his statement on Sunday and took the coded message as a warning that this is going to this is going to push him to stay in place. So his chairmanship expires in May, but he has the governor's role until January 2028. And he can remain in that seat unless he's removed for cause, basically through most of Trump's term. Now, the issue of removing for cause, of course, is front burner for the Federal Reserve because another Fed Governor, Lisa Cook, is her case is being reviewed by the Supreme Court, and they're expected to rule later this month. And if they rule in her favor, that really protects the Fed from this sort of unilateral action from the administration, really gives them a carve-out, an important carve-out.
Alistair, thank you. Alistair Bull, they're Bloomberg's senior editor, of course, for many years covering the Fed. Now, the Japanese Prime Minister, Sanae Takaishi, is reportedly planning a snap election that would provide a mandate for her to continue hawkish diplomacy and pro-stimulus policies. Well, let's get Isabel Reynolds, Bloomberg's Tokyo bureau chief, on the line. Isabel, so Takaishi only started her premiership in October. So how would calling a snap election help her, and what are the risks?
Yes, well, I think to understand why she would make this decision, you have to look at how she came to office last October. She wasn't brought in by a general election. It was just a party vote, and she was brought in to replace the previous leader who stepped down. So she hasn't had a chance to go to the public, and that's left her in a bit of a weak position. At that time, she was seen as a rather sort of fringe figure, even within her own party. She ended up alienating her own coalition partner, which left, and she had to scramble around and try and find another coalition partner. She lost her majority in the lower house at one point and ended up with a majority in neither of the houses of parliament. So there is a good reason for her to go to the public now and to try to get her own majority, a majority potentially for the LDP, her ruling party, on its own, giving her a freer hand to do what she wants in terms of policy on the budget, in terms of diplomacy, and potentially also sort of bolstering her presence on the international stage. I mean, she would be somebody who would be in place for several years to come, and people would have to take her seriously. On the other hand, I mean, the corollary of what I've said about alienating her previous partner is that the Cormator, the reason why the LDP was in that coalition with Cormator is because they were excellent at getting out the vote. This will be the first election the LDP goes into for many, many years without that partner. And whether the popularity that Takaichi undoubtedly has among the public will translate into actual votes remains to be seen.
Yeah, it always feels like a big gamble, like double quits. We've seen sometimes how it ends in the UK with prime ministers. Isabel, thank you. Isabel Reynolds, Bloomberg's Tokyo bureau chief, now joining us to discuss all of this, all of the U.S. policy, all of what we've heard from the Fed and the path ahead is Grace Peters, co-head of global investment strategy at JP Morgan Private Bank. Grace, as always, thank you so much for joining us. I mean, I feel like because of the news since the start of the year with Venezuela, oil, now the Fed chair, everything that's happening in Japan, the news cycle is just really condensed. Does it make it much more difficult to not change your calls?
No, look, I mean, we laid our outlook out last year. We had AI, we had global fragmentation, and we had inflation as our three key themes. And I think that
this
is playing out at the moment. I mean, look, geopolitics, when we think about one specific event, it really has a lasting impact on market. But what we're seeing now is something different. It's the confluence of many different geopolitical, but also political agendas, which are coming together and I think are really changing the fabric, not just of economies, but also therefore of markets and of the portfolio construction you need in this kind of world. So when we think about the economic nationalism, countries really looking inwards, national security issues, everything that supports the good of that country, that's being met with fiscal activism. You know, we saw some of that in your report on Japan, pro-growth policies. And really this does mean potentially higher growth, but also higher inflation and higher inflation volatility, which is really what we're bringing together in assets like gold, hedge funds and infrastructure to complement stocks and bonds.
Grace, how is 2026 going to be different from 2025? If you look at, if 2025 is actually President Trump laying out his agenda, are we going to see, companies, countries retaliate? And how much does that change the dynamics in markets?
Yes, I don't know so much about specific retaliation. We had some of that and a lot of negotiation through the course of last year. But I think what will be different is some of the monetary policy impulse. We obviously had a lot of cutting from central banks last year, loosening financial conditions. Some of that will come into this year, but I think this is going to be much more a year of fiscal rather than monetary policy. We need to watch, some of that monetary policy, how it flows through the system, because if you see to events like Fed independence or Fed efficacy, actually whilst the front end of the rates curve can come down a little, curve steepening and the back end going up, you're not going to get that benefit flow through the economy, and that could again have implications for correlations if we think about cross assets. So many of the themes from last year coming into this year, but different when it comes to monetary versus fiscal. I think on artificial intelligence there'll be a difference this year. Last year it was all about the capex. You saw our AI capex contribute about 40% to GDP. This year I think it's all about the use cases broadening through the economy, and when we see earnings season this year, I think a lot more companies are going to talk about their use cases. We already saw 47% of companies in the third quarter. I'd expect in fourth quarter even more. So definitely an evolution of many of those themes this year.
Grace, when you look at AI, when do we know how much job displacement it also brings? We're also hearing, not hiring freeze, but a slowdown in hiring as a lot of companies need to spend on these systems and so can't afford to hire more people right now.
Yes, I think it's definitely one of the remaining questions out there when it comes to the labour markets. There is some evidence that you're starting to see, particularly at the graduate part of the market, the job market, some potential signs that you are seeing job displacement. The 47% of companies that I mentioned for the S&P, they're generally talking about AI use cases that pertains to efficiency gains, and that's where you could see some degree of job displacement. What we think is going to be more interesting is as companies use it to grow revenue, which hopefully also opens up opportunities for the job market as well. So our expectation is that the labour market is bottoming out here, that it's going to stay a little lackluster. We're not going to go back to a super strong labour market, and that obviously opens up various paths for the Fed. Our base case is that the cyclical pro-growth impulse will mean that the Fed doesn't need to cut much this year, probably just once, but there is a possibility, Francine, obviously, that you see a lot of this growth accrue to a more narrow part of the market. That means you could see more Fed cuts. But again, I think that would be a boon for asset prices and only perhaps exacerbate some of those issues where value is flowing to owners of capital rather than to labour, which again is something that I think will feature in 2026.
And Grace, when you talk about inflation volatility, does it mean higher inflation that we didn't see in 2025? So is it a backlog?
I think you could see inflation, and I think that could start with the print that we see this week. You could start see inflation starting to come up again north of 3% through the first half of the year. I think it will fade as we go through the back half of this year.
This is what, tariffs?
Yes, but the lagged impact of tariffs, but also some of that cyclical strength when we think about some of the tax rebates and the fiscal spending that's going to come through. I think that will also be pro-growth, so higher growth, higher inflation in the US through the course of this year. I think therefore the cyclical parts of the market should continue to do quite well.
I mean, it's unclear how we should look at China, because these extra tariffs on any partners with Iran would be almost directly against China. I mean, we thought that the two superpowers were getting along a little bit better, but are we importing deflation from China, or how do you see China developing?
Yes, I mean, the relationship between the US and China, I think, is the defining relationship when we think about geopolitical, underlinings in the world at the moment. I think there are some really interesting things going on in China at the moment. Our sense is that the economy there is also bottoming out. The property market is still an issue, but it's been an issue for such a long time. I think people want to move on from that now. When we think about China's technological advancement, obviously they look at AI in quite a different way. It's not as narrow, perhaps, as the US, and therefore I think there's a big opportunity in China technology across a broader array of technologies, automation, manufacturing, etc., that I think is interesting. It's not a big allocation for us. We do think that there are interesting opportunities through EM as a result of the relationships that are developing between the US and China. But the US is still our preferred market. We do think there's interesting things in Europe for the second half of the year, but EM and China, there is a role there.
What do you like in Europe in the second half?
Yeah, so I think what's interesting, I articulated sort of this cyclical boost that we expect in the US in the first half. Some of that could start to come to Europe in the second half of the year as we think about the spending, the German fiscal spending. Defense names are still key for us. And if we do start to see that bottoming out in China, that would be positive for European sentiment and European earnings growth as it pertains to luxury goods, some of the mining companies and some of the industrials as well. So I'd own both of those regions, the US and Europe for sure, but my expectation is that the profile of growth is stronger in the US out of the gates this year and picks up in Europe in the second half.
Great. So we spent a lot of time talking about oil in the last 10 days. Have you had to change any, I don't know if it's range bound or actually if you're betting on cheaper oil because what Trump's foreign policy could do?
Yeah, it's interesting. I mean, generally we're in quite a consensus-driven market. When we look at sell-side consensus, it's pretty tight. It's tight every year, but this year particularly tight. But one of the areas where actually there's a quite wide spread is oil, and that was even before events in Venezuela and Iran kicked off in the past 10 days or so. Venezuela, I think, is less of an issue because from just, sort of supply as it is today, whilst there's a lot of reserves, sort of for future, it's less of an issue. I think when it comes to events in the Middle East and Iran, it's something to watch more closely, particularly not just the direct impact on the oil price from Iranian production, but more if we think about the flow through the Straits of Hormuz, which is obviously something we've worried about in the past and would have broader implications potentially for the path of oil and obviously inflation, but our key commodity remains gold.
I know gold was a target of 5,300,
indeed,
which is not insignificant.
Not insignificant, particularly after a strong rally last year as well. But this is still, to us, the ultimate geopolitical hedge, looking to get away from some of those overweight US dollar exposures, whether it be central banks, institutions, or indeed many of our own clients as well. 5,300 with high conviction, we'll get there.
Okay. Wonderful to have you as ever, Grace. Thank you so much. Grace Peters, co-head of Global Investment Strategy at JP Morgan Private Bank. Now, UBS Chief Executive Sergio Motti warns the proposed new banking reforms in Switzerland go too far. More of our interview next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver.
We do see opportunities.
That allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Next week, live from the Alpine Mountains of Switzerland, is the World Economic Forum annual meeting in Davos. Bloomberg Television brings you unmatched coverage and conversations with world leaders, business executives, and billionaires as they navigate responsible AI deployment, economic expansion, and geopolitical tensions. Tune in for daily coverage all next week. Context changes everything.
Well, the conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the FT is reporting this morning that the UBS chief executive, Sergio Ermotti, has confirmed he plans to step down in April 2027. It comes at a crucial time for the bank as it fights Swiss government plans to tighten its capital requirements. So let's discuss all of this in the wider banking sector with Bloomberg's Charlie Wells and Paul Davies, our banking and finance columnist from Bloomberg Opinion. So thank you both for joining us. Charlie, what do we know about Ermotti's departure, and what do we know about his potential succession?
What we know is it's looking like April 2027. And this could be a relatively opportune time because what we know since Ermotti has come into the bank to lead it for the second time in 2023 is he's really tried to project this idea of stability, really tried to kind of tamp down on any uncertainty related to the integration of Credit Suisse into UBS. And this could come at a good time, right? Because it gives a long time to look for a new leader. It gives a long time kind of leading up into the annual general meeting next year. So that is a sort of outlook for this. But of course, the FT has also reported that, the date is not set in stone yet.
What do we know, Paul? I mean, digging around, is 2027 early? Is it late? He's been in charge for quite some time and has been doing a good job.
Yeah, well, I mean, he said in 2023 when he took over that he would do it for sort of 3 to 5 years. He wanted to see through the integration of Credit Suisse. He wasn't going to stay beyond that. Expectations have started to shift ever so slightly among some analysts and investors that because of this big political scrap they're having over the stiffer kind of capital rules that are going to come in to protect Switzerland's economy against UBS as the last huge, international bank that they have there, that his departure date might start to drift, that he might have to stay until that fight was properly done. So this is kind of reconfirming that, I don't know, that he will definitely go by 2027, or very likely go by 2027. Which maybe signals that they expect the meat of the political fight to be done by then as well. But, yeah.
Do we have any idea if it would be a Swiss person or someone else?
Well, so Ermotti is Swiss, and that really has been beneficial to him in these difficult negotiations and discussions with the government. And I think we are entering Wall Street earnings season, and I think something that this is really highlighting, that you're seeing a lot of analyst commentary, not just about UBS, but is this issue of succession risk, right? We're thinking JP Morgan is reporting later today, and this is a case in point that succession can change in a heartbeat, right? And so I think this is something that is really focusing on how UBS could change, but also, how some of these other major global banks need to think about leadership.
Yeah, apart from Jamie Dimon, he's never leaving. Speaking exclusively to Bloomberg, Sergio Ermotti says proposed new banking regulations in Switzerland go too far. Here he is.
We believe that the current proposals are not really reflecting what happened at Credit Suisse and are going too far. And therefore, we are contributing in the debate with our views on the matter. But this is now a political process. We hope we're going to get more clarity by the second half of the year.
I mean, and they're looking at moving to the U.S. Is that a real possibility, or is it just fear-mongering?
Well, it's a good threat to have in your back pocket, I'd say. I mean, it's a difficult and expensive thing to get done. You know, they either need to shift themselves wholesale, which could be slow and could be costly, or they need to, you know, buy something to create a sort of a bridge. And there's kind of there's been plenty of chat around various sort of wealth managers that they could look at over there. But, you know, buying something in order to shift your domicile isn't always the best sort of, you know, strategic choice. Or they could hope to get bought by, I don't know, Morgan Stanley or JP Morgan or somebody like that. But there's no suggestion that it's going to happen. So it's sort of, you know, there's been, you know, chat that they would be welcomed by US regulators or the administration. So it's a good, you know, stick to wave. But it's, you know, is it going to happen? Probably not.
Charlie, elsewhere in banking, I mean, succession, but there's also a lot going on in job cuts. We had some at Citi and BlackRock. So how are these playing out?
Well, look, some of this is seasonal, right? This tends to happen in January. You get job cuts, you get bonuses. But some of this is structural, right? A lot of the cuts that we're hearing about 1,000 jobs at Citigroup. We're hearing about 1% of the global workforce at BlackRock. We're hearing about at UBS, which we've been talking about, some cuts in January. So these are banks that are in transition, right? These have been telegraphed long-term transitions that they're going through. The push is to try to keep expenses, you know, solid, not exceeding expenses. And so a lot of this is, you know, a fact of the structural change that a lot of these banks are going through. It's unfortunate, and some of these numbers are high, but I think we saw last month when JP Morgan talked about expenses, talked about compensation, and what that did to the share price. We're really seeing a lot of caution on expenses, and that could be playing out here.
Yeah, overall, Paul, what are you expecting from the earnings season in the U.S.? Will a lot of it be trying to navigate the political risk coming from President Trump, given what we heard on, you know, affordable housing, but also credit card companies?
Yes, I mean, it's a story of a great year in 2025 for lots of the businesses. You know, credit quality remains pretty stable, I think, for a lot of these banks. You know, investment bank fees, trading revenues have been, you know, fantastic. And on the one hand, there's, you know, attention on expenses, but there's also lots of people who are going to have, you know, fabulous bonuses compared to sort of previous years. Everything is going to be about the outlook. Everything is going to be about, you know, how healthy is the economy? Is unemployment going to rise, and is that going to start to cause more credit problems? You know, and what is Trump going to do next? You know, the tweets and the kind of the rhetoric about capping credit card interest rates at 10% over the weekend, you know, severely knocked a bunch of bank stocks and particularly the dedicated card companies in the market yesterday. I mean, again, it seems like a wild and crazy thing that is like, how do you even make it happen? It seems incredibly unlikely, but, you know, the president has shown little regard for rules or norms in kind of any arena, and so, you know, who knows?
I mean, I wonder whether this backfires. You've written about this, Charlie, that actually could be a risk for consumers.
Yeah, so look, Trump is so vulnerable right now on affordability, right? That cost a lot of elections. That helped a lot of Democrats win back in November. And I called a credit expert in the U.S. yesterday who worked at FICO, who worked at Experian, and he basically said, this looks great on a marquee, right? This sounds great as a campaign promise. We have limited interest rates on credit cards to 10%, but there could be a lot of unintended consequences for the consumer, right? This could backfire, as you say, because it could cut the number of cards that are out there for people who maybe have lower credit scores. Also, a lot of our viewers love perks. Interest rates help fund perks. So some of these very cherished rewards that come from some of these cards, that could be an unintended consequence if those have to go away.
Paul, I mean, overall, we thought, or there was a belief, I guess, in the markets that President Trump was very pro-banks. I mean, is that now being put into question?
So, I mean, yes and no. I mean, no in the sense that we've had some regulatory reform go through already. We're expecting, you know, more of that reform that's going to, if not free up a ton of capital, at least has taken away the threat that there would be severely increased capital demands in some of these reforms that were being worked on under the Joe Biden administration. But this, and I guess one of the things is that, you know, Scott Bessent, the Treasury Secretary, is the person who is seen to be leading that and in control of that, and is kind of much more of a known quantity by markets and seen like kind of an adult in the room in some ways. But yeah, again, it's things like the attack on institutional homeowners and credit cards just sort of undercuts that supposedly friendly approach.
Okay, thank you both for joining us. A great panel, of course, on everything we need to know about banking. Bloomberg's Charlie Wells and Paul Davies from Bloomberg Opinion. Coming up, the U.S. president seeks to pressure Iran with the threat of 25% tariffs on its trading partners. We'll discuss the implications with Sanam Vakil from Chatham House. That's next, and this is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.